Welcome back to Make Money Count. Today's show is for anyone evaluating their home financing options. Anyone who is self-employed or can't prove their income. Anyone who has been told no by their bank. Anyone who might be considering a reverse mortgage. Folks who may be out of work and folks who may have credit issues. We are going to unpack some great ways to make sure you're always getting the lowest rate on your mortgage in this market and in any market, regardless of your current financial situation. Today, we're going to talk about alternative lenders. There are so many alternative lenders in the mortgage market right now. It's important that Canadians understand who they are, what role they serve, and which one might be right for you. There are options available to you, and the more you know about this stuff, the more you're going to save on your family's biggest asset. Usually when you walk into your bank or speak to someone about a mortgage, you won't get very far if the amount of income you appear to be earning each year isn't deemed to be sufficient to service the mortgage payments of your new loan. Your bank doesn't care what your actual income is, and they don't care how much equity you have in your home. They want people who have regular 9-to-5 jobs. And let's face it, more and more Canadians just don't fit into that bucket. Your income could come from your retirement investment, could come from a portfolio of real estate you have. You could be self-employed or you could be out of work. An alternative lender can be a credit union or a trust company. Some are actually banks. Some are companies that are funded by banks. Some are large publicly traded corporations, and some are large private mortgage funds. The right ones are more flexible on income and credit requirements and don't really cost much more than what you'd pay for a mortgage at your bank. Some might even cost less. Today, we'll shed some light on why an alternative mortgage lender might be the perfect fit for some homeowners. We'll make sure that if you're looking at an alternative lender, you're getting the best possible rate and product on the market.
If you're enjoying the show, be sure to like, comment, and subscribe. Your support keeps us motivated and excited to bring you more insightful content.
Let's talk about alternative lenders. Alternative lenders cater to folks who may not qualify for a traditional mortgage from a bank due to credit challenges or unconventional financial situations. People who have been told no by their bank for any number of reasons. People who just a few months ago may have been coveted by the banks, but now find themselves with fewer options. People whose income has dropped, might be out of work temporarily, people who are getting back on their feet. Listen, life happens to all of us. This program is about helping you understand options that are available to you. Options that'll help you borrow as cheaply and effectively as possible, no matter what your financial situation. Keep in mind, your bank's only obligation is to their shareholders. That means your motivations are completely misaligned with the person at the bank who says they're helping you with your mortgage. All right, Justin, get us started with the key benefits when considering an alternative mortgage.
Okay, let's get started with credit flexibility. Alternative lenders often provide more lenient credit requirements compared to traditional banks. If you're facing credit challenges or you have in the past, an alternative lender is usually a great option, offering you the opportunity to secure financing when your bank has turned you away. Successfully managing your mortgage will serve as a stepping stone to rebuilding your credit. Critical to this is ensuring your mortgage gives you the flexibility to not only manage your payments, but also the rest of your finances, leaving you in a stronger position financially. So whether you have a bruised credit score, consumer proposal, bankruptcy, or for whatever reason, your bank gave you the old fix your credit and come back to us, with no real helpful solution, an alternative lender might be the option for you.
Stated income. Alternative lenders offer what are called stated income programs. This is just what it sounds like. It doesn't mean that you just write down whatever you want for your income, because that's not going to help you long term. But it does allow borrowers to declare their income without all of the stringent documentation requirements of the banks. The economy is changing. Many borrowers don't have the conventional 9-to-5 jobs that bank underwriters understand. With an alternative lender, you have the flexibility to present a more comprehensive picture of your financial situation. They understand that traditional methods may not accurately reflect the financial stability of a borrower with multiple properties, or a borrower with multiple sources of income, a borrower who may be retired. This flexibility opens up doors for individuals who might face challenges securing a mortgage from the bank, or may think that they're forced to take a reverse mortgage. Alternative lenders are all about using every source of income available. Instead of using the net income you pay tax on, alternative lenders often allow self-employed borrowers to use the gross income their business is generating. Alternative lenders allow borrowers to add back expenses and account for things like rent they may be receiving. Canada is a country built on the backs of folks who are self-employed. Unfortunately, our banks use being self-employed as a way to force borrowers into high interest rate, unsecured debt. Alternative lenders can help you reduce those debts by working with you to better understand how you make your money.
All right, let's talk a little bit about debt consolidation. For those managing multiple higher interest debts, an alternative mortgage can provide an avenue for debt consolidation. By rolling all of your costly unsecured debts into a single mortgage, borrowers will benefit from lower overall interest rates and simplified repayment structures. It's one payment, and it does two things. It simplifies your financial obligations and puts your hard-earned, and might I add after-tax money, back in your pocket by saving you a ton on interest payments. Remember, every dollar you owe in unsecured debts comes with a way higher payment than a mortgage. If you owe $50,000 on a credit card, you're probably looking at a payment of approximately 3% or $1,500 to service it. That same $50,000 in a mortgage will cost you approximately $300 a month. That means you're bringing your overall cost down and amortizing your debt, meaning you're actually paying it down as opposed to just keeping it afloat.
Alternative credit lines. These are like the home equity line of credit, or HELOC, of the alternative lending market, because sometimes it makes no sense to break a first mortgage, but you still need some capital. Whether it's for home improvements, investments, or unforeseen expenses, a home equity line of credit stands as a readily available resource. It gives you the flexibility to access your home's equity with ease. Imagine consolidating your credit card balances, personal loans, and other debts into one coherent and structured repayment plan. You may end up paying a few percentage points more than your first mortgage rate, but these credit lines can help boost your credit score and get you back on track.
Now, it's crucial to acknowledge that with any financial product, alternative mortgages, like all mortgages, come with considerations. First off, depending on your exact situation, you may pay a slightly higher interest rate due to the increased risk associated with lending to individuals with credit challenges or unconventional income. That's not to say that you're definitely going to pay a higher interest rate, but it is a possibility. However, in the grand scheme of things, there are almost always significant benefits to this, such as lowering your tax bracket as a self-employed individual and still qualifying for that mortgage you want, or focusing on fixing your credit and getting you back to a better overall financial position.
Duration of mortgage. Alternative mortgages usually have shorter terms than traditional mortgages. While this can be advantageous in some cases, it's also vital to understand the implications and plan accordingly. The best way to treat these loans is as a bridge to get you back to lower interest rates. Even if the rate on an alternative mortgage is only a point or two higher than an A mortgage, the main goal for you and your mortgage advisor should always be to get to lower cost financing. Another thing to consider are the equity requirements of alternative lenders. The more equity you have in your home, the cheaper an alternative mortgage can be. The other thing to consider is that alternative lenders will typically only lend up to 80% of the value of your home. This will force many first-time home buyers out of eligibility. So if you're buying in this market and you need to rely on an alternative lender, you really want to be certain that you have your down payment figured out and also what your path to lower rates is. Don't worry, it's definitely something we can help you with. An alternative mortgage lender can be a solution for folks facing unique financial situations. They provide flexibility and personalized solutions. And most importantly, when they're done right, they open up possibilities for homeowners who might otherwise be struggling to secure financing.
If you have any questions about B mortgages or want to share your experiences, drop a comment below, hit that like button, hit subscribe, and as always, stay informed, make savvy financial choices, and remember to make your money count. Thanks for tuning in.